Hello and welcome to XP Actuarial's Video of the Week series, Week 1. Today we will be covering key topics in capital budgeting. We will cover material from Corporate Finance Chapter 8 and Corporate Finance Chapter 18. The first topic I'll discuss is free cash flow from earnings. When we're dealing with capital budgeting, we usually discount free cash flows with some appropriate rate. Now, free cash flows are cash type items, so we want to use cash items in our calculation. Now, the free cash flow is simply the unlevered net income after tax plus depreciation minus capex minus the change in net working capital. Now, since depreciation is a non-cash item, we need to add it back because of it being a non-cash item. We also need to remove capex, which are our capital expenditures during the period, and remove our change in net working capital, which I'll explain below. Now we can rearrange these terms to make it a little easier, and it becomes revenue minus cost of goods sold after tax minus capex minus change in net working capital plus tau, or tax rate, multiplied by depreciation. Now, net working capital is simply our current assets minus current liabilities. Examples of current assets are cash, inventory, and accounts receivable. And examples of current liabilities are accounts payable or short-term loans. Now, our change in net working capital at time t is simply our net working capital at time t minus our net working capital at time t minus 1. Now, if we go through a simple example, we have cash and accounts receivable as current assets and accounts payable as current liabilities. Now, we can calculate the net working capital at each time. So net working capital at time 0 is our cash plus our accounts receivable minus our accounts payable, which is 200. And our net working capital at time 1 is 180, our cash plus our accounts receivable minus our accounts payable is 155. So our change in net working capital at time 1 is 155, our net working capital at time 1, minus 200, our net working capital at time 0, which is negative 45. So our net working capital has decreased by 45 over the period. Now, some other cash flows to consider in capital budgeting are the following. First is opportunity costs. Now, think of a project that requires a building, and this building could have been used to rent it out to a customer if it wasn't being used for the project. So this lost rental income is known as an opportunity cost and needs to be removed from the value of the project. Second item is cannibalization of existing products. So say you introduce a new product which replaces an old product. Any sales of the old product that would have happened hadn't the new product been introduced need to be removed from the value of the project. Now, the third item are sunk costs. Now, these are things like past R&D expenses, and they shouldn't be included in the calculation. The final item are liquidation values or salvage values. Now, for example, say you bought a machine for $10,000 and used it for 5 years. At the end of 5 years, it still has a market value of $1,000. This value of $1,000 should be included in the calculation, as you can sell the machine at that time for that amount. Moving on, we'll cover the weighted average cost of capital. This is a staple in capital budgeting. Now, if we have a constant debt equity ratio, the WACC will remain constant as well. But if our debt equity ratio changes through time, we actually need to calculate a new WACC for each period of time. Now, the WACC is the average between the cost of equity and the after-tax cost of debt. Now, the VL0 term here, that is your levered value of a firm, and it is equal to the present value of the free cash flows using our WACC as the discount rate. The easiest way to show this is through an example. Now, suppose a firm has 100 of equity, 100 of debt. RE is 10% and the cost of debt is 4%, and the tax rate is 30%. And also assume that the firm has the following free cash flows. and you're asked to calculate the levered value of the firm. Now the first thing to do is calculate the WACC. Now using the formula above, we have E over E plus D, RE plus D over R, or D plus E again, multiplied by RD, which is 4%, multiplied by 1 minus our tax rate. Now that gives us 6.4%. Now the levered value of the firm is simply the present value of the future cash flow, free cash flow at the WACC. So we have a stream of payments of 30 for 4 years, which are our free cash flow. So this is an annuity using our WACC. So we pop it into a familiar annuity formula, and we get 103.008. Now, with WACC, we have to maintain a constant debt equity ratio to keep WACC constant through time. So we need to determine the level of debt each period that keeps this ratio constant. And this level of debt is called the debt capacity, or DT, and it is represented by D times VTL, where D is your debt to value ratio, debt over debt plus equity. In our example above, we had 50%. VTL is, of course, your levered value of the firm. So if we use the above example, and we can calculate debt at time 0, which is simply 50% multiplied by our levered value of a firm, which was 103.008. So that gives us a value of 51.504. Now we can continue to calculate the amount of debt for the first period. What we need is the levered value at time 1, and we can use a shortcut formula as follows. You take the levered value at time 0, multiplied by 1 plus your WACC, minus your free cash flow at time 1. So we take 103.008 multiplied by our WACC, minus our free cash flow. And that gives us a value of 79.6005. Now D1, we use this formula as well. 50% multiplied by our VL at time 1. So our amount of debt that we need at time 1 is 39.80. So moving on, we can cover the adjusted present value, or APV method. And what the APV method does is it splits the levered value of a firm into the unlevered value and the PV of interest tax shields. Now, if a firm maintains a constant target leverage ratio, the interest tax shields have the same risk as the firm, and therefore we can discount them at RU, the unlevered cost of capital. So if a firm maintains a constant debt equity, the RU is simply the pre-tax WACC, or it is simply the average of the cost of equity and the cost of debt. The interest tax shield at time t is simply tau, our tax rate, multiplied by RD, multiplied by dt, which is our debt at time t. The levered value of the firm is the unlevered value plus this PV of interest tax shields discounted with RU. And our unlevered value is simply the present value of our free cash flows using RU. So using the example above, we can continue on. Now the interest paid in each period and interest tax shield in each period need to be calculated. Now this will give us the present value of interest tax shields. So what we do is we take our debt at time 0 multiplied by our interest rate. So 51.504 multiplied by 4% is 2.06. Now 39.8 multiplied by 4% is then 1.592. And then we just continue on calculating our interest portion for the remaining periods. Now we need to calculate our tax shield, and our tax rate was 30%. So 2.06 multiplied by 30% is 0.618. 1.592 multiplied by 30%, 0.4776. and then we repeat for the remaining periods. Now that we have the interest tax shields, we need to calculate RU. Now RU is our unlevered cost of capital. So again, we use 100 for equity, 100 plus 100 for equity plus debt, multiplied by our RE, and then we put debt, equity plus debt, multiplied by our RD. Now this gives us a rate of 7%. So now our unlevered value of the firm is simply the present value of future cash flows using our RU. So it's again our annuity formula, this time with 7%. And now that gives us 101.616. So now we need to calculate the PV of our interest tax shields. Now that would be 0.618 divided by 1.07 plus 0.4776 over 1.07 squared plus our third interest tax shield discounted for 3 years, and finally our fourth. Now that gives us a value of 1.3917. Now to calculate the levered value of the firm, it's simply VU plus our PV of interest tax shields. So it's simply 101.616 plus 1.3917. That gives us 103.008, which is the same value that we got using the WACC method above. Now, the final method we'll discuss today is the flow to equity method. The flow to equity method uses free cash flow to equity. Now the free cash flow to equity is simply your free cash flow minus your after-tax interest payments plus net borrowing. And it can be written out in a longer form by examining an income statement. So you can take sales minus cost of goods sold minus your operating expenses minus depreciation minus interest expense minus income tax plus depreciation minus your capex minus your change in net working capital plus net borrowing. Now net borrowing is simply your debt at time t minus your debt at time t minus 1. Now you discount the free cash flow to equity with the equity cost of capital RE, not your RWACC or your RU. Now FTE method requires that the firm's equity cost to capital be held constant. This is only true if the debt to equity ratio is held constant as well. So moving on, we'll cover a commonly tested question and actually a common mistake that a lot of students make. So suppose a firm has a current cost of equity of 12% and a cost of debt of 6.67%. The firm also has a debt to value ratio of 25% and a tax rate of 40%. You are asked to calculate the new WACC, assuming that the firm increases its debt to value ratio to 50%. Now what a lot of students do, and is actually a mistake, is just calculate the WACC with the new debt to value ratio using the old RE and RD. So we would put 0.5 multiplied by your RE plus 0.5 multiplied by your RD multiplied by 1 minus your tax rate. Now that gives us 8%. And then they would continue on using that WACC. Now this is incorrect. The correct procedure to follow is to first calculate your RU with the old debt to value ratio. So your RU is simply 0.75 multiplied by 0.12 plus 0.25 multiplied by 0.0667. Now that gives us 10.67%. And then what you do is you use the WACC formula as follows, which is RU minus D RD TC. And what we use is our old RU, our new debt to value ratio, and our RD and TC. So it would be 10.67% minus our new debt to value ratio multiplied by our RD multiplied by our tax rate. And that gives us 9.34%, which is higher than the 8% the wrong student calculated. And it's higher because we've increased the debt and therefore have taken on more leverage, so it makes sense that our WACC should increase. Now we'll cover a couple other leverage policies, the first being a constant interest coverage ratio. This is where interest is a constant percentage of free cash flow each year. Now with this leverage policy, it's easiest to use the APV method, and we discount our free cash flow and our interest tax shields using RU. So you just continue on as before, but your interest payments each year are just K times your free cash flow, and then you discount them just as before with RU. The second type of leverage policy is a predetermined debt level. So debt is set according to a fixed schedule ahead of time. Again, it's easiest to use the APV method with this. And now, since we know the debt ahead of time, we can predict the interest amounts ahead of time. So we'll discount our interest tax shields using RD, not RU. But we will continue to discount our free cash flows with RU. And finally, we have periodically adjusted debt. So example would be debt is adjusted annually. So we know the interest expense at time t. So if it's adjusted annually, we would know 1 year of interest expense. Now since this is known, we should discount these interest tax shields using RD. And the interest tax shields past 1 year are unknown, so we should continue to discount these using RU. This concludes the video of the week series for week 1, and I hope you have learned a lot, and tune in next week for video of the week, week 2.